name is Mary Paula Pariado. I'm a teacher for corporate financial analysis. In this session, we'll be discussing the concepts of revenue, expenses, gains, and losses. So by the end of this session, you should be able to explain revenue, how revenue can be recognized in the books of accounts, be able to explain the concepts of expenses and identify these expenses in financial statements, and also we'll discuss the concepts of gains and losses. Now, revenue may be defined as actual or expected inflows of cash or other assets, or reductions of liabilities that result from the normal operating activities of the business. Now, any expected inflows or actual inflows that we receive in the form of cash or in the form of other assets, or reduction in liabilities that result from the normal course of business that the firm undertakes, is what we refer to as revenue. So revenue are any increases in the value of the assets of the firm. Like we made mention earlier, assets is the sum of capital and liabilities of the firm. Now, if your assets increases or if you are expecting any economic inflows or economic benefits that result from your normal operating activities as a firm, then that is your revenue. Now, revenue is measured by the charges that have been made to customers against sale of goods or services rendered. So usually you can obtain revenue from two forms depending on the nature of business that you're undertaking as a company. So it's either you're undertaking or you're into the sale of goods or you're into the rendering of services. And therefore any inflow or any benefit you receive by undertaking any of these activities is what you would recognize as your revenue. Now, recognizing revenue depends upon the enterprise that you find yourself in as a business. Now, you as a firm, you would want to recognize revenue, especially from the sale of goods, when you have exchanged the goods for a consideration, partly or wholly in monetary form, or usually that is referred to as price. And now you have transferred, or all significant risk and reward has been transferred to the buyer of that particular good. Also, you should make sure that goods or the goods that you are selling have been delivered to the buyer, either in actual or constructive form. And also, you as the seller, you retain no effective control of the goods. And then you have transferred all the goods and its associated risk to the buyer. Now, you should make sure that before you recognize revenue, there is no significant uncertainty regarding the amount of consideration that is called price, and that price may consist wholly or partly of money, would be derived from the sale of that good. So if it's uncertain that the buyer of the good would actually pay for those goods that you deliver to them, then you cannot recognize that as revenue. Okay. So that is when recognition of revenue comes in. You have to consider by it when you should record that particular sale as revenue into your books of account. Now, when it comes to expenses, they are the monetary value of resources that has been consumed by the enterprise in the course of generating revenue for the enterprise. So in the case where you are into the rendering of services, any kind of resource you consume in the course of rendering that service to the customer is what we call expenses. So assuming you have to install a software for a customer and the customer is not close by, so you have to pick a car or use the company's car to move from your location to the customer's location in order to install that particular software for that person. The transportation cost you incur, or the cost of fuel that you incur in the course of generating that revenue you make from installing that software for that customer, is what we term as expenses. Now, these expenses result in the reduction in the assets of the company, or also they may augment the liabilities of the enterprise. However, the benefits you derive from the expense is exhausted within the accounting year in which it is incurred. So in other words, expenses do not take place for more than one accounting year. And this is why it is treated in the income statement, because they relate to a particular accounting year, and that's expenses charged. So the expenses may be administrative expenses or general expenses or selling expenses when the transaction has to do with the sale of goods of the enterprise. Also, when it comes to the concept of gains, they refer to any net income that is received from incidental activities of the firm. By incidental activities, I mean those activities that are not the core or the primary activities the firm engages in. So if the firm is a publishing company, those activities other than um, printing books or purchase, yes, any other income or any other funds you receive other than printing of books or publishing of books is what you refer to as a gain. So gains are just surpluses that arise out of any activity other than the primary operating activities of the firm. So usually they are non-recurring in nature. So for example, if you're a book publishing company or a publishing company, at a point in time you have to sell any of your fixed assets. Let's say you have to sell a printer or any furniture or fittings, or you receive any commission, then it is a gain for the company and not a revenue. So gain is recognized only and only if it is realized. So if you don't sell any of your fixed assets to gain any surplus, then you are not supposed to realize any gain. When it comes to losses, they are defined as that part of expired cost from which no benefits can be derived for generating revenue from incidental activities. So let's say you have an investment, and upon the sale of that investment, you obtain less than you actually got, or less than you actually gave up in order to purchase that investment, then it's a loss for you. Or in cases where there are foreign exchange losses, or you allow discount on the goods that you sell to your customers, you've already sold the goods and you've already allowed that kind of discount, and therefore it's an expired cost and you don't expect to receive any benefit from that, and that is what we refer to as loss. So like I mentioned earlier, examples include the losses on the sale of non-current assets. So if you buy an asset or you buy a plant for, let's say, 50,000 cedis, and you sell the plant for 45,000 cedis, the difference of 5,000 cedis is a loss to you as a business. And also, if you allow discounts on your goods or the services that you render to your customers, that discount allowed is also a loss to you as a company. So in this session, we discussed the concept of revenue, expenses, gains, and losses, specific items that are used in recognizing revenue, and also the definitions of these items according to IFRS. We should also take note that gains come from incidental activities or activities that are not part of the primary or core operating activities of the firm, and that losses are also expired costs from which we do not expect to derive any benefits. Also, when it comes to revenue, we only recognize revenue when we have exchanged our goods or services for a consideration known as price, which consists wholly or partly of money. We have transferred all significant risks to the buyer, and also the goods have actually been delivered to the buyer, and also there is no uncertainty attached to that sales we are making. Thank you.